Welcome to this edition of our MDM Amplify podcast, which is all about elevating vendor voices and industry solutions that serve distributors. This episode is sponsored by Grant Thornton. I'm Mike Hockett, MDM's executive editor. On July 4th of this year, the Trump administration's landmark tax bill, the One Big Beautiful Bill Act, was signed into U.S. law. Also known as OB3 or the OBBA, the bill offers long-sought tax certainty for the business world and global tax reform. That sounds like good news for distributors who are in the midst of combating tariff impacts, cost volatility, and constant competitive pressures. To break it all down, this episode features a conversation with three experts from Grant Thornton, which is a leading professional services firm known for its expertise in audit, tax, and advisory solutions that help organizations navigate complex business challenges. Here, Storm Sixies, Russell Norris, Colin Wilhelm, and myself unpack what's in the One Big Beautiful Bill as it pertains to distributors, how it will impact them going forward, and how it can inform strategic planning and drive growth. Enjoy. All right, let's kick this off with some quick introductions. Storm, do you mind going first with a quick bio here?
Sure. Thanks for having me. My name is Storm Sixies, and I am Managing Director and the Tax Policy Legislative Affairs Leader at Grant Thornton in the Washington National Tax Office here in D.C. I've been in tax policy world for almost 25 years now in D.C., starting from Capitol Hill through large association, working for a big inbound defense company as a consultant, and just this spring coming to Grant Thornton.
Very good. Over to Colin.
Hey, I'm Colin Wilhelm. I'm a manager for legislative affairs in our Washington National Tax Office. I'm also a recovering journalist. I was one of the people chasing around senators and congressmen for quotes for several years, covering tax policy and other economic matters. And I've been with Grant Thornton for a couple of years.
And over to Russell.
Thanks, Mike. Russell Norris. I am a tax partner in our Charlotte, North Carolina office, and I also lead our transportation and distribution practice. I've been with Grant Thornton for about 20 years and appreciate the time today.
All right. Well, great to have you all here. Let's start by setting the stage here. The One Big Beautiful Bill, it offers long-term tax certainty, but the broader market still remains very unpredictable. We know that distribution companies are navigating not only all the tax reform issues, but certainly tariffs have dominated discussions all year. There's trade policy shifts, sourcing changes, and constant margin pressures. So, Storm, I'm going to direct this first question to you, but to help our listeners understand the landscape that we're dealing with here, what One Big Beautiful Bill implications should distribution companies be most aware of in terms of which policy changes matter the most, and how are these impacting their tax planning, their investment decisions, or their operational strategy? So just your thoughts on that.
You're absolutely right about the current environment right now. What we're hearing and what is very clear is that the tax bill provided a great deal of certainty. There were a lot of business-friendly provisions in this legislation that are very positive for businesses, and the fact that they were made permanent was very important, both for the companies themselves and for members of Congress who really pushed for those permanent provisions to allow for more stable business planning, for more predictability, more stability. I think there's plenty of recognition that that is important for businesses to be able to have that clarity. At the same time, though, we've got this significant instability and uncertainty coming, as you mentioned, from the tariffs, from the economic global atmosphere, from trade uncertainty, labor markets. All of that is causing a little more uncertainty. So kind of giving with the right hand and taking away with the left to some degree. But as far as the bill goes this summer, as I mentioned, this was really positive for most businesses. Unless you were in solar or wind energy, you really came out of this quite well. A lot of provisions that there was some concern about going into this bill didn't come to fruition. So there was no increase in the corporate tax rate. There were no changes to the cap on business SALT deductions. There were a lot of positive changes and none of the really feared for broad negative changes. So that positive long-term certainty is really what is enabling some more proactive planning by businesses. But we are still waiting to see kind of how the tariff situation shakes out. The Supreme Court is going to be hearing a big case coming up in the next few weeks, and we'll get some kind of decision, hopefully in the next couple of months, that will provide a little more clarity on what those tariffs look like. But one of the issues there is that the Trump administration has really been pulling in quite a lot of revenue from these new tariffs. And that was one of the reasons that the Republicans were willing to spend as much as they were on this tax bill and to provide as much permanence in tax policy. And so if the tariff revenue goes away, there could be some more pressure on Congress to come up with some new revenue sources. And that could provide a new aspect of risk for businesses. Although, it's hard to see this Congress raising the tax rate broadly on businesses. Colin, you've been watching the tariff situation really closely. What do you see with that decision coming up and the revenue pressures?
Yeah, it's only, a $300 billion question, right? As to whether or not the country-specific tariffs that the Trump administration has put in place through a fairly novel read of an existing national security law will be upheld by the Supreme Court. And whether, even if the Supreme Court rules against those tariffs and the use of that law to put those tariffs in place, whether the relief looks like refunds or whether it just looks like, hey, don't do this moving forward. So there's a lot of uncertainty around that. It could be a potential windfall for some companies that are paying tariffs or have been paying tariffs over where they're getting their product from or raw material from. But I wouldn't count on that either. It's not something that they can say, okay, we're going to get, X amount of money refunded when the Supreme Court rules on this. We don't know. The Supreme Court very well could rule in favor of the Trump administration. Traditionally, the Supreme Court has given a lot of leeway to the executive branch over national security matters. And in previous challenges to this law, not over tariffs, but over other issues, they've ruled in favor of the executive's powers here. It's mainly a sanctions law. Yeah.
Yeah,
So
we've seen a lot of wins for the administration. We honestly have no idea which way this lawsuit's going to come down. And so there is still that remaining uncertainty that's out there. But I do think that distribution companies can use at least the tax bill clarity to move from being a bit more reactive when they didn't have when there were these expiring provisions or provisions that had already expired that they were having to deal with, and being able to be a little bit more strategic about how they're investing. This could be a significant cash windfall for a lot of companies, given some of the really important business provisions that were in there. The full expensing of domestic R&D expenses, the return to 100% bonus depreciation, and the more favorable calculation of business interest. All of those are provisions that allow for the opportunity for some serious cash windfalls for companies almost immediately if they choose. And there's a lot of flexibility there for companies to find the best mix of these business provisions that gives them the outcome that they're looking for. And that's different for every company, whether that's immediate cash because they have a need for it and they have things they want to immediately invest in, or whether they're looking for a lower effective tax rate over the long run or over the next few years.
You also have the creation of this new qualified production property deduction. We haven't seen some regulations out of Treasury yet, but this is essentially an onshoring incentive to go along with the sticks of tariffs. So it's the major carrot that's within OB3, as people in the Beltway are calling it, to incentivize onshoring of production, and that would then have some downstream effects for distribution too. So basically, it's a novel expensing provision that would allow a company to deduct the expense of a structure, which is new. Bonus depreciation typically doesn't extend to structures as long as it's involved in the substantial transformation, basically manufacturing and production of things that fall within the parameters of the law. And so that's something that we could see. It's on a temporary basis. It's mainly for new facilities, although there are some qualifications for existing properties that are converted into like a manufacturing facility. That is kind of the major temporary business provision here that we're looking at as an incentive, but that's something that could be really attractive to a lot of companies and have some potential implications for the distribution industry as well.
That's great commentary there. And we know that uncertainty has been the word of the day for all of 2025 so far. Well, we survey our audience all the time, asking them, how is all this tariff uncertainty affecting your pricing strategy? How is it affecting your technology investment strategy? These big things that these companies want to do over the next year. But there's been kind of a holding pattern while the ground has continued to move under the feet of these distributors. So any kind of clarity that they can get on the economic front, on the tariff front, on the supply chain front is going to give them a little more confidence to finally pull the trigger, I think, on some of these more investment oriented decisions that they've been wanting to make.
Okay, I think that's the goal of the Republicans in this bill, is really trying to, going back to 2017 and the Tax Cuts and Jobs Act, the push there was for business growth, for business investment. And again, revisiting that law as they were looking at some expirations, as they were looking at some sunsets on many of these provisions. Even on all the international provisions were set to have rate changes at the end of this year. The new law does change those rates, but not nearly as much as they were scheduled to go higher. And so I think that was the big incentive for Congress in this bill, was to stabilize and to make favorable the business environment, to grow the economy, to really incentivize investment, to incentivize companies to hire, to build, to make capital expenditures, all of that. And I think there's a lot that can be done with some of the cash that's being freed up now from these provisions, whether that's automation, whether that's modernizing your technology, modernizing your warehouse operations, improving your fleets of vehicles, hiring new people, all those kinds of things. That's what this bill is intended to juice.
And we know that interest rates play a factor here as well, that we have seen better momentum on that for businesses. It's down near closer to 4% now. It looks like we're probably going to get another rate cut in December. So I think that's another thing that's going to, if that happens, give a little more confidence, a little more momentum towards companies making some of these investment decisions. So before we move on, just any other final thoughts on the overall concept of this bill providing more stability against all of this volatility that these distributors have been dealing with all year?
I think that companies can, as I said, do some more proactive planning than they've been able to do in recent years. And some of these decisions can be made, or need to be even made, on a quite timely basis. Given the opportunity for new cash from some of these provisions, you may want to make sure you're not overpaying your estimated taxes for 2025. So these are things to look at even before the end of this year. Colin mentioned that qualified production property deduction, which is, you can take your property that would have been depreciated over 39 years and expense it entirely in year one. But that's, at the moment, only good for a few years. And so if you're going to do that, that's something that has to be planned pretty quickly, because it obviously takes time to plan a building and get shovels in the ground and get construction started. And there are specific timelines there. So I think the timeliness is something that I would really emphasize, and just the being more strategic and proactive rather than just as reactive to some of the economic indicators out there.
I would add too, even though we have this uncertainty over the upcoming Supreme Court case and where they're going to fall on the country-specific tariffs that the administration's rolled out, the administration has also initiated a lot of other product-specific tariffs around things like aluminum, steel, car parts, copper, that fall more into the traditional range of tariff powers for the presidency. And those are probably sticking around for the long haul. I would suggest, businesses at least plan for that. And so this is a good opportunity with these tax changes, this tax certainty to basically, you're going to have long-term pressure on margins from those tariffs, but you can maybe address some of that through these tax provisions that Storm's been going through.
Well, I think we really covered the situation of what distributors are dealing with in terms of the uncertainty that they've been facing all year and what this bill is hoping to appease with its main goal here. So I want to dive a little deeper here, get more into the weeds on this, and get into, given this policy landscape, about how distributors can turn the incentives that are in this one big beautiful bill into a strategic advantage. Some of this we've already touched on, but Colin, you might be the best to attack this first with just asking, what are the most important business decisions that these distributors should be prioritizing right now to take advantage of the opportunities that come out of this bill? Where can they really help their own advantage here?
Yeah, I mean, I think it gets back to what we were talking about before. We have a return of 100% bonus depreciation. Whether or not the qualified production property deduction is something that might apply for them, and whether shifting a supply chain to the U.S. And onshoring, as the administration wants people to do, is something that makes sense for them from a business perspective. You've got the more generous calculation of 163J for you've got the DA back with EBIT in terms of that, and basically taking a better net interest deduction. And then R&E is also at least on a domestic basis, is at a better, more favorable provision where you can immediately expense it instead of doing a 5-year amortization.
Yeah, but think about it for distributors. Think about the process innovations that they're developing. That's eligible now for immediate expensing under the newly restored domestic R&E if they're doing that onshore. For 100% bonus depreciation, like we mentioned, your fleets of vehicles, robotics, automation tools, all those capital expenses that you might be putting in warehouses or elsewhere in your distribution supply chain, those are all eligible.
So
Yeah,
some of those
are
elections do have to be made pretty quickly. In some instances, for some businesses, I am not a CPA, so I won't pretend to play one on a podcast. But we're starting to get regulatory releases from Treasury already. And so we're emphasizing to businesses that they need to be paying attention to those and could, need to make elections on a pretty quick basis here. So that's something to be cognizant of moving forward.
Yeah, and I'll just add real quick that, with the thin margins that a lot of the distribution companies are facing, the 163J interest expense limitation has been extremely painful for the last couple of years. And, it's a significant favorable change that should help with free cash flow and effective tax planning. So it's a really big item in addition to what Colin and Storm have mentioned.
Yeah, and I think, like I mentioned earlier, there's a lot of optionality and some transition choices that can be made in some of these provisions that really allow companies to put themselves in the best financial position for whatever that means for them. Not every company is going to be better off taking R&D in year one or taking all of the unamortized expenses from the last several years all in 1 year. That may put them into an NOL position down the road that they don't want. So there's some dials there that can be played with on each company's basis to figure out the best position to put themselves in.
Just any other commentary here on the big ticket decisions that distributors should be prioritizing right now to take advantage of the bill?
I think a
I would,
lot of it will be pretty straightforward to them because a lot of this is a continuation of a policy originally set by the Tax Cuts and Jobs Act. So a lot of these things were in law for several years, and then they started to phase down in 2022. So I think you will see a lot of familiarity here, but it's something that will hopefully take pressure off some companies that they might be seeing on the other end from tariffs.
yeah, I think we don't ever want, and it's rare that the tax tail wags the business dog, or however the saying goes. But these tax provisions and these tax strategies can really be integrated with your business plans to put the company in the best position possible.
To add to that, the permanent nature of these provisions, I think, is really important too. As companies, look and plan further out than maybe just next year, I think having some certainty around that is very important.
Well, I think that covered a lot of good ground on what distributors should be looking at and prioritizing. And I don't think any distributor executive is going to read every page of the One Big Beautiful Bill, but it's nice when we can provide an executive summary in even in a podcast form like this of the big things that they should be keeping in mind. So before we start wrapping up here, I'd really love to kind of just close this with getting some key takeaways for distribution leaders to how they can get ahead with this bill, what the next step should be, or maybe a first step as they start to strategize on how they can take advantage of the opportunities in this bill. Russell, continuing with you, any final thoughts here on your advice would be for distributors as they watch and see what's happening? We know that there's the Supreme Court case on tariffs coming up that everyone's going to be watching, but outside of that, any general advice that you would have for distributors as they're watching what the fallout is going to be of this One Big Beautiful Bill?
Yeah, absolutely. And I think we've kind of laid out a pretty good summary, and to kind of wrap things around distribution in particular. If you take a step back and you think about entering 2025, many companies were facing thin margins, recessionary pressures, and there was a lot of optimism that 25 would be a pretty big year in hopes that a tax bill would be passed. Enter the first couple months of 2025, and I think everybody was surprised by the tariff discussions. Probably didn't have the right planning in place for it. And sounds like based on, what we've talked about and what we know today that, those tariff pressures are going to continue at least for the near term. But the great news is that we did get the OB3 bill in place and we have the tax certainty, and many of the provisions are permanent in nature like we talked about. And so as companies are experiencing reduced taxes, more opportunities for investment, I think that the key is to take a step back and really think strategically about where you're trying to head. Though we may not have an answer in the near term on tariffs, we do have a tax answer. And so what are the priorities for your company from a strategic perspective? Is it network optimization and looking at strategic locations? Is it predictive analytics and AI adoption? Fleet maintenance, load optimization, the AI-driven tools that really are helping companies succeed right now. What should you be investing in? What should you be redeploying cash savings from taxes to? And really thinking about where you're trying to go long term. And so I think the key takeaway is take advantage of the near term tax opportunities and really redeploy that cash to the right spots to provide strategic success into the future.
Colin, over to you. Same thing. Your final thoughts or key takeaways that you're thinking about out of this discussion.
Sure. I mean, Russell spoke well to the tax certainty that's created by OB3. Excuse me. But I would continue to anticipate that tariffs stay in place for the long haul. Even if these country-specific tariffs are struck down by the Supreme Court, you still have a pretty broad toolkit for the administration to keep a lot of tariffs in place. And the president has said that tariff is his favorite word in the English language. He seems pretty committed to this. So I do think that there could be political and economic pressures that change that calculus down the road. But for now, the administration is continuing to move forward with Section 232 investigations. We also have a port fee that is going to go in place later, a little bit after. I don't want to date this reporting too much, but October 14th. So it's going to be pretty timely. And yeah, just a number of other product-specific tariffs that we anticipate the administration moving forward on. So be prepared for that. Continue to roll with the punches and try to maybe use some of these tax provisions to stem some of the immediate margin impact from that.
And I know uncertainty has been I said before, the word of the day for 2025, but at least distributors have now had, 7-8 months of Trump 2.0 tariff experience. So I think that they've started to find their sea legs when it comes to dealing with tariffs, even though the situation keeps changing. I think distributors have just come to know that uncertainty is the state of the industry right now. So Storm, same thing, key takeaways from your point of view?
I think now that the tax bill has passed and we know what the tax landscape is going to look like probably for the next number of years, that companies need to think as strategically as possible and not as maybe reactive as they have been. This is now a landscape, at least on the tax front, that they can plan it within, and they can think about really their business, what is going to make them most competitive, what investments are going to give them the best forward-looking growth in the industry, and be able to plan within that tax system. So I think, yeah, just the idea that now is the time to really lean into your strategic thinking and away from your reactive thinking in order to put yourself in the best competitive position.
That's a great note to end it on. Well, thank you to the three of you, Colin, Storm, and Russell, for your expertise here. Our audience can contact Grant Thornton, especially you three, for a wealth of information on this topic and a lot more insight on tax implications, the impact of tariffs, and navigating the different supply chain impacts. So there is a wealth of knowledge at Grant Thornton for our audience to tap into. I'll provide some contact information in the blog write-up for this podcast. But with that, thanks to our panel here, and thanks for joining.
Thanks so much for having us, Mike. We really appreciate it.
Thanks, Mike. Appreciate it.
Thanks, Mike. I should plug real quick, or not plug, but also mention the anticipated 25% tariffs on medium and heavy trucks that the president has promised to go into effect November 1st, although they were originally promised on October 1st, and we didn't see any executive order on that. So we'll see what happens.
Yeah, it seems like it is going to happen inevitably. It's just a question of the timing here. So good nugget to throw in there. Well, thanks again for everyone involved. And I think this was a great discussion. So thanks once again. And thanks for listening.
Thanks.
Thanks, Mike.
Thanks for listening to this episode of the MDM Amplify podcast, which was brought to you by Grant Thornton. If you have questions about today's discussion, please reach out to our panelists. And for more insights and updates from Grant Thornton on regulatory and legislative changes, visit grantthornton.com/insights/DC-dispatch. And for all other distribution and transportation insights, check out gt.com/transportation to explore resources and subscribe for alerts.